Hi, I'm Rick Kaler. Thanks for joining me. 5 years ago, the U.S. government was injecting trillions of dollars into the U.S. economy. Conventional wisdom suggested that rising interest rates were soon to follow. Some were even calling for the collapse of the dollar and hyperinflation. Well, instead, inflation's down. The dollar is the strongest it's been in a decade. And interest rates, well, they're falling to the lowest rates we've seen in decades. Now would be a great time to dig out all your mortgage loan paperwork and consider refinancing. I would suggest that you start with finding out what your current interest rate is on your mortgage loans. Let's assume that you currently have a mortgage with a balance of $200,000, a P&I, that's principal and interest payment, of $1,013 at an interest rate of 4.5%. So next you want to do a little shopping. Call 2 or 3 mortgage brokers and find out the interest rate you could obtain on a new loan. You will need to give them your household income, the value of your home, and the current balance on your mortgage. And if you don't know the current value, just to call your county director of equalization and ask them about the assessed value of the home. Some states that this doesn't work in, but in South Dakota, the assessed value is typically pretty close to what the market value is. Then ask the broker to give you the interest rate and payments on a mortgage that's almost equal to the number of years you have left to pay on your loan. So if you had 16 years left to pay, you might ask them to give you a quote on a 15-year mortgage. Also, find out what the interest rate and payments are on a shorter term loan than your current mortgage. Maybe comparing a 15-year to a 30-year mortgage. Or, if you've got a 20-year loan, maybe you want to compare it to a 15-year loan. Some lenders just offer 15 and 30 years. Others will even offer a 10-year or 5-year loan. So you have to ask them how flexible they are. Usually a shorter term has a lower interest rate. So, for example, as of February 3rd, 2015, when I did this video, one local lender was offering a 30-year rate at 3.65%, and that's with no origination fee, and a 15-year at 2.875. So be sure you get the most current rate, because rates fluctuate daily. So make sure you call and see what they are today. They could change by the time you go in to make an application tomorrow. Next, you're going to get the broker's estimate of your closing costs. And these are the expenses you're going to need to pay to close a loan, like title insurance, the cost of appraisal, closing fees, points, and other various fees. Lenders sometimes will charge points, also known as origination fees, which are included in the closing costs. 1 point equals 1% of the loan's value. A mortgage is described as no cost or 0 points don't carry this cost. But the interest rate could be higher, thus increasing the long-term cost of the mortgage. So you need to check that out. So with all this information, now you're ready to analyze whether getting a new loan makes good financial sense. So let's assume you find out you can obtain a new loan with a similar term at 3.65%. The monthly payments would be $915 and the closing costs about $1,900. The new payment is $98 less than your current $1,013. So dividing the closing cost by the monthly savings, that's $1,900 divided by 98, gives us 19, which is the number of months you need to keep the house in order to break even. So if you intend to sell your home in the next 2 years, probably not advisable to refinance in this situation. You've got to calculate your situation to see if it makes sense. I also typically advise against refinancing if the months to break even are much over 24. Few of us know what curves life may toss us, and looking 2 years ahead is my personal comfort level. If your break-even point is 24 months or more, I would suggest you either wait for interest rates to fall further, if that's possible, or shop for a loan with lower closing costs. When shopping for a new mortgage, you might be tempted to reduce your payment even more by lengthening the term of your new loan. For example, if you had 16 years left to pay, you might want to go out and get a 30-year loan. While the benefit is more short-term spending money, the downside is many more years of having a house payment. You will also pay more in points and interest rates, typically, to get a longer term loan. For example, currently, the 15-year loan is 2.875, and the 30-year loan is 3.65%. Quite a difference. So my strong suggestion is to obtain a new mortgage that's equal to or less than the number of years you have left to pay on your current mortgage. Remember that a lower interest rate doesn't automatically mean refinancing is in your best interest. The amount of money you save monthly, the amount of your closing costs, and how long you plan to live in the home are key variables that influence whether you should refinance your mortgage or not. Thanks for joining me.